Key accounting principles. Key accounting principles form the foundation for financial reporting and are essential for maintaining consistency, transparency, and accuracy in accounting practices. 1. Accrual principle. Revenue and expenses are recorded when they are earned or incurred, not when cash is exchanged. This helps in providing a more accurate picture of financial health. 2. Consistency principle. Once an accounting method is chosen, it should be used consistently in all periods to ensure comparability of financial statements. Any changes in methods should be clearly explained. 3. Conservatism principle. When faced with uncertainty, accountants should report expenses and liabilities as soon as possible, but only recognize revenues when they are certain. This ensures that financial statements do not overstate assets or income. Foregoing concern principle. This assumes that the business will continue its operations for the foreseeable future and not be liquidated. Financial statements are prepared under the assumption that the entity will not cease its operations. 5. Matching principal. Expenses should be recorded in the same period as the revenues they help to generate. This allows for accurate measurement of profitability for a specific period. 6. Materiality principle. Information should be disclosed in financial reports if its omission could influence decisions made by users. This allows businesses to focus on information that is relevant to their financial performance. 7. Full disclosure principle. All information that could affect the understanding of a company's financial statements must be disclosed. This could include footnotes or supplemental data to explain specific items. 8. Cost principle. Assets should be recorded at their original cost rather than their current market value to avoid subjective valuations. This principle focuses on objective and verifiable data. 9. Revenue recognition. Revenue should be recognized when it is earned and realizable, regardless of when cash is received. This ensures that financial reports accurately reflect a company's performance during a period. 10. Economic entity principle. The business is considered separate from its owners or other businesses. All financial transactions related to the business should be recorded separately from the personal finances of its owners.